Investors Chronicle.
Hello and welcome back to the IC Interviews podcast. I'm Dave Baxter. I'm the funds editor on the Investors Chronicle, and today I'm joined by Nick Train, the renowned UK equity investor. Nick, thanks very much for joining. How are you getting on today?
Dave, I'm well. Thank you very much. I don't know about renowned. Let's hope it's not infamous. But I have been doing it a long time. And I think there are things to be said about UK equities. And let's hope in the course of this conversation we can touch on some of those important things.
Yeah. Okay. So let's first go into the renowned versus infamous debate. You, of course, in recent times, again, have kind of apologized for kind of underperformance versus the market. The likes of Finsbury Growth and Income have kind of lagged somewhat. But what do you think could kind of end the spell of underperformance? What are the kind of bright spots that we might see?
Okay. Listen, I am the first. I hope you'd acknowledge I'm the first to acknowledge that it's been a disappointing few years for our efforts to make money for investors out of UK equities and to do better than the index. And I'm disappointed. I'm disappointed as an investor in the strategy myself. I think, though, I'm allowed to notice, and I suppose I'm going to say it, but I don't really want to make a big deal about this, but I think I'm allowed to notice that performance has improved somewhat over a short-term period, like over the last 3, 4, 5 months. Performance, particularly of Finsbury, has improved. And, performance has to start picking up sometime, of course, and let's sincerely hope that 6 months ago was the nadir for this strategy. Of course, I don't know. It's just a hope. But if our strategy is to continue recovering, I think it's most likely to be as a result of this. I mean, what's helped over the last few months has been the strong business performance of a number of big holdings in our UK strategy. And these are big holdings in what I would call substantive, globally oriented growth companies. And actually, such substantive global growth businesses, you can find them on the London stock market. It's been so frustrating for a number of years that good or even better than good business performance by such companies hasn't been rewarded by strong share price performance. Perhaps over the last 6 months, that's begun to reverse. And if these companies can continue to show good, particularly better than expected growth, I would expect investment performance to continue.
And do you have any, I suppose, kind of bright spots there? Equally, are there any parts of the portfolio where you're still harboring doubts, concerns?
To me, a central proposition, which is being tested or has been tested, but a central proposition is that contrary to common perceptions, in fact, the UK stock market does offer access to global growth themes, and investing in those companies that offer access to those global growth themes can be and should be very rewarding. So, for instance, we are believers in the likely commercial implications of the application of artificial intelligence tools to digital businesses' services. Shorthand, we think AI is for real. And of course, when people think of AI, they think understandably of Nvidia or Meta, or whatever, and one's not denying that those companies are also big beneficiaries of artificial intelligence. But a company like Relx, for instance, which is a major holding for us and has become a very significant company in the UK stock market, I think you could argue that Relx offers just as certain and rewarding exposure to artificial intelligence technology as some of the US giants. Genuinely, that's true. And, maybe that's enough to make Relx an interesting investment. In fact, I'm sure it is. Maybe it's enough to make Relx and some other businesses listed in London really, really interesting investments, because arguably global capital providers haven't identified them yet. Does that make sense?
Mm. Yes, yeah. And you've spoken a lot about kind of AI and I suppose perhaps making the portfolio a bit more suited to kind of this digital worlds and so on. How much of the portfolio do you now think qualifies as perhaps targeting, either the AI trend or more broadly sort of just tapping into those digital trends? And would you expect to kind of go even further in trying to focus on that area?
It's certainly been a significant shift in the structure of our UK strategy over the last 5 years. I mean, we've owned Relx, for instance, since 2002. Look at the share price chart. It's been amazing. Arguably, it's only just getting started, and I'm serious. We've always had an exposure to these digital businesses listed in London. But I will acknowledge that through and after COVID, which clearly has acted as an accelerant for both businesses and consumers around the world engaging even more with digital products and services, we've looked to increase the exposure to such companies, either by building the holdings further or in some instances adding new names. And I think for Finsbury, for instance, the exposure to such digital businesses is now about 2/3 of portfolio value. And that's up, well, from less than 40%, for instance, back in 2019. So I would say that that's been a significant shift in the portfolio, and let's hope it's going to pay off.
And you mentioned Relx, that's clearly like a very large holding in the trust, nearly 13% last time I looked. Experian is on a similar weighting, London Stock Exchange to Sage Group, also pretty hefty in there. At the last annual general meeting, I believe, you've kind of taken some questions about the concentration of the portfolio. Some people are getting a bit concerned about whether there needs to be a change of tack in order to address some of those performance issues. What is your kind of response to that?
Well, listen, after really quite a prolonged period of underperformance, you'd expect and indeed welcome scrutiny of the portfolio and the investment approach that we work with. And it's absolutely undeniable that portfolio concentration cuts both ways. When you have a concentrated portfolio and you've got a lot of winners amongst your holdings, then your returns can be remarkably good. And this is totally my fault. For sure, over the last 2 to 3 years, I've perpetrated a number of long-term big holdings that at least temporarily have fallen, and that's been a big retardant on our overall return. What I'd say, though, to frame this is that passive and index type offerings are, they're valid for investors. It's valid that investors should have the opportunity to invest in a passive index-oriented strategy at a low cost and just capturing the performance of the index. And that's not going to go away, and nor should it go away as a potential investment option for savers. What can or should active managers do in those circumstances? Well, I think the answer is the same answer that it's always been, is that active managers need to take some kind of risk over and above the risk that is intrinsic to the index in order to try and beat it. And all I know is that when I look back at, what was your adjective? Mine was infamous, renowned, I don't know, whatever. When I look back over multiple decades, you hope those multiple decades have relevance for the future, but you don't know. I'm still in the business because there has been a decent long-term track record. Let's hope we can make it continue. But that long-term track record has come from this very specific type of risk that we take still today, which is big positions, concentrated positions, but concentrated on predominantly substantive, big cap, globally oriented companies. So I think that the individual risk of being invested in a London Stock Exchange group, or a Diageo, even to pick one that's hurt us recently, or a Relx, I don't think that the risk is that high, because the companies have market positions and brands and cash flow that make them intrinsically really quite predictable investments. So yeah, other people take risk by trading, other people take risk by investing in small speculative companies. I'm not saying there's anything wrong with that. We're trying to add value by taking a very specific type of risk, concentration, but concentration in, I'm not asking you to do it, I'm not asking your listeners to do it, but look at the top 10 holdings, let's say in Finsbury Growth and Income Trust. They are pretty much, household names. It's not difficult to understand, I don't think, why we might be attracted to those sorts of businesses. Dave, is that fair enough?
That makes sense, yeah. But let's turn then to kind of individual holdings. I suppose your funds are kind of perhaps easier for people to make a call on, given they are pretty concentrated. But you mentioned Diageo. That's perhaps been one of your more kind of troubled holdings as of late. There have been inventory issues in Latin America. You've had concerns about the slowdown or even reversal of the premiumization trends, and just generally various uncertainties. For example, in the era of Trump, we don't know what's going to go on there, with things like their manufacturing in Mexico. What is your kind of outlook for the stock now? Are you kind of moderating your conviction? What is your kind of bull case there?
Okay, so the short answer is that we've been adding to the holding as and when we can. Sometimes we can't because the position is a big position, and we do have portfolio construction rules, and we can't add more in certain cases. But where we can, we have been adding to Diageo. What I'd say about Diageo, again, at a very, very generic level, is that Warren Buffett says somewhere, even great companies sometimes can see their share prices halve. It's not unusual, even for an outstanding business, such as I believe Diageo is, for its share price. No one wants it to happen, but it can happen. I think that Diageo's share price today is, let's pick a time span. It's an arbitrary time span. It's a once in a decade opportunity to access the equity of what is evidently a world-class growth business at a trivially low valuation. That's the way I would see it. I would see that because I believe that the drivers that have made Diageo actually such a successful investment over the last 20 or 30 years, it has been, even having fallen recently, it has been a very successful business and share price. I think that the growth drivers remain intact, and arguably the growth drivers are getting stronger over time. I think that premiumization perhaps has slowed somewhat, but it definitely hasn't gone into reverse. We have the advantage of having seen Diageo's presentation at the CAGNY conference at the back end of last week, where the company was able to point to, I think, some very, very reassuring data showing that premium spirits continue to take share both of customers' overall wallet, but also, even more so, share of customers' expenditure on alcohol. So premium spirits continue to take share during a difficult period for consumer confidence. I think that the most likely thing is that perhaps as a result of Trump's economic policies, I think that consumer confidence, particularly in the United States, is likely to improve over the next couple of years, and that when it does, there will be a marked acceleration in the consumption of Diageo's premium brands, and that will lead to a big re-rating of the shares. Now, you might say that sounds like wishful thinking, and I don't deny we would very much like that to happen. But I would ask skeptics to note, even through this more difficult period for all consumer companies, look at the performance of Guinness and look at the performance of Don Julio Tequila, which is Diageo's that is the #1 tequila brand in the world and Diageo's biggest tequila brand in the United States. Those brands are booming, and they're booming because particularly younger consumers who are purportedly not interested in drinking actually love Guinness. They love the heritage of Guinness, and they love tequila, and they love Don Julio tequila. So I think that the pessimism is just way too intense.
So do you not share the same concerns then of some managers who worry about, I suppose, a general trend away from drinking alcohol, and even, their theories, for example, that the weight loss drugs will kind of, again, shrink that demand?
Candidly, we don't know. But what I would say is that the trend for consumers to drink less alcohol per capita has been evident for many decades. Yeah, I mean, people are drinking less alcohol per capita per year than they were doing so 50 years ago. And the bull case for a company like Diageo is not based on the proposition that there are going to be more alcoholics in the world drinking ever increasing quantities of hooch. That's not the bull case. It's not what's driven the share price in the past. What has driven the share price in the past is people drinking less, drinking more mindfully, and choosing premium beverages that have some taste or heritage or provenance that makes the experience more valuable for them. I think the other thing to note, and it's kind of related, is that Diageo is the biggest spirits company by some margin in the world. And yet Diageo only accounts for roughly 4% of all alcohol drunk around the world in any given year. So I don't want to be complacent about it, but the other 96% could be stable. It could even be shrinking somewhat. But that doesn't mean if you've got 4% with the best brands that people want to experience, that you can't take more share. Does that make sense? So I think, ostensibly, if you own the world's best whiskey brands, which they do, the world's best tequila brands, which they do, if you own Guinness and nobody else owns Guinness, then you've got an investment in some really, really durable brands that you can see consumers remain intrigued by, curious about, and will drink more of.
So let's stick with, I suppose, consumer stocks for the time being. Unilever is another big holding. There's still a bit of concern about its ability to kind of win market share, even though it has kind of hunkered down to focus on its power brands. It did have a good year last year, but there are concerns about the outlook. What is your take there? Again, is that something that you're kind of buying into still?
The past might not be useful, but the past is the only thing that we can have any certainty about. Do you know what I mean? Now, if I tell people, which we do, that so far in the 21st century, Unilever's investment returns, its capital value plus its dividends, Unilever has outperformed the NASDAQ so far in the 21st century. That surprises people, because people say, well, Unilever's this boring, low growth consumer company, and NASDAQ is NASDAQ. It's the hottest market on the planet. But are you seriously telling me that Unilever has done better than NASDAQ so far in the 21st century? Well, it has. And that's partly because NASDAQ was very high at the start of the 21st century and suffered damaging declines that it took a long time to recover from. I've no idea whether NASDAQ is high, low, or indifferent at the moment, but one has to accept that those tech sectors do occasionally go through periods of excess, and it can take a while to unwind it. But that's not the central point. The central point is that a company like Unilever, they're rare. Businesses like Unilever are rare, that have brands, hundreds of brands that are embedded in consumer behaviors in hundreds of geographies around the world. Those companies can and do, historically anyway, let's use a trivial word, they eke out inflation-protected returns over time with regularity. I think that maybe the future is different, but I think that anybody who's skeptical about Unilever should look at its past history and then say, could Unilever, with its current set of brands, its current market positions, and the capabilities of its executives, could it find ways to continue to deliver attractive, steady returns in the future? And I think, when you look at Dove or Hellman's or the premium beauty assets that Unilever owns, you can see why the company could and should continue to deliver those sorts of returns that in no single year look dramatic, but that over time lead to satisfactory returns.
And obviously, consumer stocks have long been a kind of part of your process. But earlier we were discussing, the move to more, I suppose, companies with data, companies that are a bit more kind of digital facing, that kind of thing. Are you kind of happy with the mix in terms of the level of consumer exposure at the minute? Or would it potentially get a little bit edged out in the portfolio in the coming years if you are going for something that's perhaps a little bit kind of shinier and a little bit more kind of digital oriented?
I think all of us, definitely me, you have to learn lessons. And I do think that what NASDAQ and other indices and companies has demonstrated is that the advent of digital industries, digitally oriented businesses that have emerged in the 21st century, we like investing in brands, and we are still invested in consumer brands, and I'm maybe we've said enough about them, but what's attractive about them is that the brands tend to be highly durable and they generate high cash flow returns on capital. I think what's happened in the 21st century is that new business models based on ownership of data or software tools have also demonstrated the ability to earn durable, high cash flow returns on capital. And I've chosen to shift the weight of the portfolio towards businesses of that type to a degree, not because I'm pessimistic about the outlook for Guinness or Johnny Walker, but because I can see that, I don't know, Rightmove's market franchise or Sage's intact software service, which is winning market share in the United States, can offer similar durability, but with even better cash flow return characteristics. That's what I would say.
Yeah, yeah. Interesting one to watch then. And I suppose talking about a different shift, we spoke before, perhaps around 18 months ago. We're kind of partly talking about the woes of the UK market and some nascent hopes that perhaps UK listed companies might move a little bit away from the kind of dividend infatuation that we've seen for a very long time, and perhaps there is scope for a bit more of a focus on organic growth. What's your view on the situation now? Do you think we have seen more of that shift take place, or are we kind of roughly in the same place we were back then?
I do think that there has been a shift, but I admit to you, I would find it difficult to prove it uncontrovertibly from a statistical perspective. It's more anecdotal, but just sharing a couple of anecdotes with you that make me more confident rather than less confident about the outlook for the UK. I would point to the, I think, important symbolic moment in 2024 when Relx's market capitalization exceeded that of British Petroleum's for the first time. Relx, which started this century at about number 68 in terms of the rankings of the all share, is today the fifth biggest company in the UK stock market, one ahead of BP. And Relx has been a great dividend growth story, but it's never been a high dividend yielding share. And I think that the wealth that's been created by Relx, compared, and I don't wish ill on any company, but compared to the very disappointing returns from British Petroleum over the last 20 years, that's likely to focus not just my attention, but everybody's attention on what UK companies can you invest in that have secular growth opportunities like Relx. I think that's, well, maybe I won't say anything more about BP, but I think that was a symbolic event. I also think that, again, in 2024, the fact that Rightmove was able to see off the bid approach by the Australians without any real dissent from its institutional shareholders or from the media, is telling you that UK investors learned a very bitter lesson when they sold Arm to SoftBank back in 2016. In hindsight, losing that tech business was a grievous loss for the London stock market. And I can see, I hope, that investors are now seeing the value of the UK's growth businesses, like Rightmove, with more clarity than they were back in 2016.
On the Rightmove bid, do you have a kind of idea of what might be fair value for the company, what you actually would be more sort of warm towards if someone else were to come in with a bid?
Well, it's trading at £6.50 roughly today. I would have thought that a bid of about £118 a share might be interesting. Listen, and I say that, listen, obviously I say that glibly, very glibly, but I say it because since Rightmove listed in 2006, its shares have gone from the equivalent of about 35 pence to £6.60. That's an 18-fold increase over the last, whatever it is, just under 20 years. And I think maybe the company can't fully repeat that, but it's by no means a mature business, in our opinion. There is so much more that could be done to digitize the residential real estate market in the UK. And Rightmove is investing, we know this, is investing significant capital into tools to enhance the experience for both buyers and sellers in the housing market. That's a big multi-decade opportunity ahead of it. And the current market cap of, £4 to £5 billion doesn't begin to capture the full potential of that growth opportunity. So I don't know if £118 is the right level, but I think what was notable was that institutions weren't kind of trying to split the odd 50p with Rightmove and the Australians. It was just, at the moment, there isn't a price at which anybody's prepared to seriously consider selling the company.
Yeah, that makes sense. I wanted to turn then to a name in the portfolio that has looked a bit more troubled, and in a sector that's looked a bit more troubled, in the form of kind of Schroders asset managers. And UK listed asset managers have sort of been a bit in the doldrums for many years, you could argue, but some do remain optimistic. What is your kind of take there?
A very specific take. The requirement for trusted, effective advice for individuals' savings or wealth, the requirement for a trusted and effective advice is stronger than ever. And with each new chancellor in the UK, for instance, the complexity, the challenges confronting individuals to make rational and wise choices for their savings just intensifies. In the case of Schroders, because of business decisions that company has taken over the last 15 years, the company is in a position as a trusted provider of that sort of value-added advice. And that's where I would expect asset growth and the source for better performing business and share price from that company.
That makes sense. And another corner of the, I suppose, financial space that we've seen a lot going on with recently is, of course, investment trusts. Of course, you work on Finsbury itself, but we've seen, Saba, the US activist, try to take over some trusts. We've seen some other activity in an activist bent as well. I just wondered what your thoughts were about sort of activism in the trust space. Should we be seeing more done from trusts themselves, or does it seem like the industry has kind of gotten its act together to an extent after a difficult couple of years?
Well, at a very strategic level, I would encourage investors, in the context of their own personal financial affairs and so on and so forth, I would encourage them to consider the utility to them of investment trusts, because they are unusual. Investment trusts are unusual in having this market sanction against underperformance or poor governance. The fact that, and it's not just in recent months, but in previous market cycles for as long ago as I can remember over the course of my storied multi-decade career, there have always been activists looking to shake up the share registers or the boards of underperforming investment trusts that aren't doing anything of particular value to their owners. And that's been a useful backstop for investors in the trusts over time. Either the trusts perform well and everybody's happy, or they don't perform well and you've got the potential for a market-oriented intervention to improve matters. I don't know where we are in that cycle right now, but I wouldn't see that what's happened over the last 6 months as being anomalous. I'd see it as part of this historic quality of investment trusts that boards, it's good. Boards really are mandated to make things better for their shareholders.
Yeah, definitely. And I just wanted to touch on, you, I suppose, have had a busy period for Finsbury recently. You're not known for sort of buying and selling that often, but of course you've added a couple of companies, Clarkson and Intertek, to the trust. Do you expect yourself to be kind of more active in future in terms of things like turnover, or is it just, how things happen to fall with these two that you've kind of moved into them now? Yeah, what's your kind of stance there?
Well, I think my stance is that since 2020, we've initiated in 5 new companies. That's like 1 a year, and that feels, not this is a good or a bad thing, that feels normal. That feels normal. But for our type of investing, but you're right, we did initiate in 2 together during the 3rd quarter of last year. And maybe there's just a couple of things to say there. One, very, very generally, the UK stock market, there are so many anomalies in the UK stock market. I mean, there's lots of things that we could do. When an index performs as poorly as this one has for so long, that there are plenty of things to be interested in the market.
Yeah.
But just in terms of what we're interested in, I do think that, listen, 2 years ago, I read the same books about artificial intelligence and digital data companies as everybody else did. And those books were enlightening and made us return to our universe of potential investments, and also to consider adding some new companies to our universe of potential investments, UK companies with unique, world-class, either data sets or types of intellectual property. And in their own ways, both Intertek and Clarkson have either data or intellectual property that is world-class. And yeah, there are others as well in the UK, which we may or may not add to, but it's an important theme, and it's an important theme that's well understood, let's say, in the United States. Maybe there's more opportunity to access companies of that type in the UK today because of the poor performance of the index over long periods.
Yeah. Lots of food for thought, but I'm afraid that is all we have time for. So I'd simply like to thank you, Nick, for coming on. Thanks for taking the time. And thanks to everyone for listening. Take care.